Hello everyone, welcome here. This is Thomas from TradeWin. In this video, I will review with you the 20-year study I made on markets correlations. For those of you who are new to the channel, this channel is dedicated to give you data-proven evidence about opinions and ideas you might have on how markets work. So I usually take historical data and try to prove right or wrong based on historical data, any opinion out there. I have already performed some backtest review for some specific trading strategies. Here we will focus on markets correlations. So I always specify in the description of the video the really precise timestamps so you can jump directly into the core of the results if you want to. But I like to share with you my whole thought process so you know how I work and what I think. So first I will recall what the scope of this study. I will recall for some of you if you are not aware of what asset correlation really is, and then I will give out the results. Let's go. So the idea was first to answer those two questions. The first is, why am I reviewing the correlations that may exist between different class of assets, and why is that important? The second is there any kind of correlation, and if yes, how do I use that to build a diversified portfolio? So those are the main questions that I'm answering in this video. So I decided to work on the universe of 39 assets from 7 different markets. I extracted the data from Yahoo Finance. So it's like extracting the daily data, so the daily candles for the past 20 years on all those assets. So you can see that I included in this study Forex, metals, US treasuries, energy, US indexes, other indexes, agriculture and farming. Okay? If you don't really know what the different symbols refer to, I invite you to go to Yahoo Finance and directly tap those symbols and you will find what they are related to. What is asset correlation to start? So this is quite simple and I will explain this to you very quickly. Correlation of 1 between two assets means that two assets move exactly the same way. Negative correlation of 1, so correlation of -1, means two assets move the opposite way. And correlation of 0 mean two assets move independently. Okay, so here you understood that I'm focusing on historical data. So if I have a correlation close to 1, it means that over the time, two assets move very similarly the same way. Okay? So for an example, here I have many curves. If we start from the left, we can see that both the orange and blue lines move the same way. We say that they have a correlation of 1. In the middle, well, there is no direct link between the orange and blue line, so maybe I'm exaggerating a little bit. Maybe it's not exactly 0, but you need to understand the idea that they seem to move independently. And finally, they move the opposite way. It's a correlation of -1. Okay? So once you understood that, you understand what market and asset correlation is about. Is in fact simply answering, do they move the same way or not? The opposite way, or do they move independently? Okay, so let's go with the results from the index correlation study I made. Let's take the correlations between, I will say, indexes. So I took French, German, some of European indexes. I took the Nikkei from Japan and the US indexes. Okay, so I didn't make the difference between indexes and futures. So for example, here I choose the future, here the index, okay? It doesn't really matter here in the scope of this study. So what do we see in this table of correlation for the past 30 years? Okay, that's what's it about. If you recall what we said, a correlation close to 1 means assets are correlated. -1, they are inversely or negatively correlated. And somewhere in the middle, we say that the assets are not really correlated. Okay? So how to read this table? It's really easy to understand. You can see that we have the same assets here and there in the Y and X axis. Okay? Axis. You can see that the diagonal here is always really red dark because we are here correlated at 1. If I take this square here, it compares the correlation between the FTSE, okay, the English index, and here the FTSE. As they are exactly the same assets, okay, the correlation is 1. It's the dark red you have here, okay? So all the diagonal here corresponds to correlation of 1 because it compares the same assets. So what do we see here? We can see that we have here a huge red dark square that only says that all US indexes, the S&P, the Nasdaq, and the Dow Jones, move the same way. So you may already know that, but here there is kind of evidence of that. We can also see here another dark square which says that European indexes always move the same way also, even if the red here is a bit lighter than the US indexes. Okay. So when we don't have too much red, for example, in this line, okay, in this column, it's because we have the Spanish index. So it seems like on 30-year historical data, the Spanish index doesn't seem to be too much correlated to, for example, the Nikkei. That's this square, which is very light. And US indexes, okay? So that's the kind of information you can get studying those correlation tables, okay? In order to be more extensive, okay, that's correct. I produced the same table over different period of time, okay? So here is the one from the previous slide, the 30 years, but I also did for 20, 10, 5, and 2 years in order to see if different periods, and when we come closer to 2024, we have the same correlations or not, okay? So what's obvious here, it seems that when we reduce the study time, when we get closer to 2024, we can see that the table gets darker, really red dark, okay? This says that the smaller the period when we approach our times, the more all the assets are correlated, okay? So here the whole table is red, which means that for the past 2 years, okay, all indexes behave quite the same way, okay? It seems that everywhere we are above the 0.5 mark in correlation, which means we are correlated with a very strong correlation here in the US indexes, okay? What's interesting to see is that at the beginning here, or in the long term, we see that the Spanish index seems to be really different from the other indexes until we reach the 10 years mark, okay? But after that, it really seems that Spanish index, IBEX, just becomes another world index, Okay, so that's pretty crazy in those tables. The key takeaway from this analysis is that world and US indexes are really strong correlation. There was an exception for the Spanish index, but it became just another world index. So if you hear anyone telling you that they diversify their portfolio buying indexes over the world, they just didn't make this study and they don't understand that all world indexes are really highly correlated between them and between US indexes. Okay, so this is the first takeaway of this video. Second, let's study a bit of some correlations between Forex pairs. I did exactly the same study. Okay, we keep the same correlation idea. If we are here really dark red, Forex pairs are correlated. If we are deep blue, we are inversely correlated. And if we are here quite in the middle, assets are known to be not correlated. They move quite independently one compared to the other. So what's really here impressive is to see that the US dollar index, okay, is highly negatively correlated to the other pairs I've chosen. Okay, so I chose the Australian dollar, the British pound, the Canadian dollar, the euro, the Japanese yen, the New Zealand dollar, and the Swiss franc. Okay, again, it's really important to have a look at what is the period I have been testing this here for the past 24 years. Okay, so as expected, we have the US dollar, which is highly, I would say, inversely correlated to all the other. Perfect. And that's per definition, because if you understand what the US dollar index is about, it's how it moves compared to all the other currencies in the world. So just as the same, let's do the same for different time periods. 23 years, 20 years, 10, 5, and 2 years. So what's the main takeaways of this? Okay, we can see that, so a standard pattern, as I explained previously in the video, the diagonal here in every graph is 1. It's because we compare an asset with itself. So in every correlation table, you have this diagonal, which is red. Okay, correlation close to 1. So here, what can we see? We can see, for example, that some here, I will say, Forex pairs are highly correlated to each other. For example, if you take this square, it's, I believe, the darkest after the diagonal. It's comparing the euro, okay, with, in the line here, the British pound. So those two assets are really highly correlated. You can see that in all the, we'll say, different time periods. Okay. So if you say yourself you trade euro and GBP, hoping that they are different and they will move, I will say, differently because you want to diversify your trading strategy, then you may not be quite right doing that. Okay. And also, what's really appealing here is once again the confirmation that the US dollar index is highly uncorrelated, inversely correlated to the euro. So here is the darkest blue square, which is the same that here. We compare euro to the US dollar index. Fine. So that's the kind of conclusion you can make. You can come back later to this slide. You can make pause and just study what all this means. Okay, for example, you can see that for the past 10 to 5 years, this Swiss franc, I will say, pair is quite uncorrelated to any other pair. Okay, so it might make sense to trade Swiss franc with another pair here in the red square. Fine, do you understand? So the darker it is in red, the more correlated assets are. The more blue the squares are, the more inversely correlated we are. And when we are in these, I won't say light squares, it just means that we are independently, we are not correlated at all. Okay? So that's the kind of information you can get from this study. So, as we know, dollar index and blah 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 USD pairs move in the opposite way because that's the definition, and here the historical data says exactly the same. So using the dollar index as confirmation for euro and GBP entries makes sense because they move the opposite way. So you can find areas in both trading charts to confirm the entries. Okay. Swiss franc used to be quite neutral, but it recently became quite correlated to euro and GBP. Okay. So these are the key takeaways from this Forex quick analysis. So now let's dive into the global, I will say, analysis comparing each asset with any other one. So we get this kind of huge table. So as you saw in the first slide when I described the universe of the assets, we have treasury notes, Forex, energy, metals, agriculture and farming, and world indexes. Okay. So again, the structure is always the same. You take the diagonal, it's always equal to 1 because you compare again an asset here, for example, cacao, with the same asset here, cacao. Fine. So I purposely put the same assets within a market, the one next to each other, in order to make appear, as you can see, some squares. Okay, you can see some dark squares here that appear, and those squares, as a reminder, say that we are correlated with each other. So if you take, for example, this dark square where we have different kind of oils, crude oil, gasoline, and heating oil, okay, same here, we can see they are really correlated. So trading those three assets thinking they are different assets doesn't make sense because they are really highly correlated. Same here for metals, copper, gold, and silver, for example. Okay. Same for all agriculture and farming. They seem to move the same way. That's quite crazy, no? And we fall back to US indexes, and I only kept the German DAX index. Okay. So what's fun here is, well, how do I choose assets that still stay in this minus 0.5 correlation range, which means that they move independently. That's the idea. So in order to do that, okay, this is the recall I will say, you can focus again and make the study for different time periods. So 10 years ago, 5 years ago, and 2 years ago, and you will see different kind of results. Okay, so again, this is for you. You can make pause and just do your own analysis on these results. Okay, we might have some very different behaviors whether you are studying on the 2 years time frame or 10 years time frame. Okay, so you need to keep a global view on all of that. Okay, fine. So for example, you can see here the dark square of US indexes and world indexes keeps staying, I would say, really dark independently from the period. So this reveals that it doesn't matter if you work on 2, 5, 10, 20 years, the correlation on world indexes is really high. That's what's about, okay? If I take another zone, for example, this zone, this blue zone, it seems to say that we are here with world indexes, okay? And here, talking about agriculture, okay, futures. We can see that on the long term, we are kind of correlated, not so much in the 5-year time frame, but seems to be quite heavily inversely correlated in the 2-year time frames. Okay, so that's the kind of info you want to get from this data. Okay, perfect. So again, because of the structure of this correlation matrices, you have a symmetrical pattern from this diagonal. Okay, so this here rectangle is exactly the same that the one here. This rectangle red one is exactly the same that the one here. Okay, that's because we compare each of the assets with themselves and all the other. Fine. So what are the key takeaways from this? So we already knew that, but now we have a clear confirmation that assets within a same market are very highly correlated. So indexes move the same, metals move the same, agriculture and farming move the same. Okay. So now here is my takeaway. So this is not financial advice. It's only how to pick some assets that have the lowest correlation between themselves. Okay. So here are, for example, the assets that keep having a low correlation between them. Okay, so I tried to pick one asset in each asset class and compare them in different periods. And here that's we get. Just a reminder that because the matrix seems to be quite light in color, okay, we are not as correlated as on the other matrices I showed you previously. Okay, so for example here I chose the euro, the S&P 500, the cacao, platinum, natural gas, treasury notes on the 5 years, and soybean meal. Okay, and here whether you work on different time periods, you can find, I would say, some assets that remain grossly not really correlated. Of course, for example, on 20 years, we can see that euro and palladium seems to be correlated. Okay, that's a surprise. Doesn't make any sense, but it seems to be the way. And here, for example, you can see that the euro also and the US Treasury note 5-year seems to behave the same. Also, we have a square that seems to appear here between the S&P 500 and cacao. Okay, that's funny. Why not? Fine. So how did I get that? I just tried to pick in the previous here tables the light squares and make sure if I can't find an asset that it's not correlated or really lowly correlated to any other one. Okay, so that's how I built this, I'll say, virtual portfolio. So that's all for today. Thank you for your time. Don't hesitate to contact me. I have an X account where I try to share my work. I'm reachable by email too in my DM. So have a good day, and it's time to backtest.